So let's take a little while and talk about corporate performance, governance, and business ethics. The real point of this reading is to consider business ethics in light of competing stakeholder interests. So we have lots of stakeholders in the firm, some external, some internal, so that can be, the public, customers, government, those types of things, or it could be shareholders, employees, other insiders, board of directors, those types of people. And they all have different needs, different desires. How is it that the firm is going to satisfy these, and what are the ethical implications for management in terms of satisfying these different stakeholders? So we can start with this idea of stakeholder impact analysis, SIA, and the purpose is to, force is a strong word, that makes it sound like it's a government thing, but maybe cause. Its purpose is to cause the company to identify which stakeholders are most crucial. So what we need to do is identify, relevant stakeholders. So, well, the shareholders are probably paramount in most of these analyses, but also employees, and then we could have the customers and government and whoever else it would come into play. What are their critical interests and desires, their demands? And then how do we prioritize them? So who's going to come at the top of the list when there is a conflict between the interests of two different stakeholder groups? And in the end, what we want to be able to do is to design a business plan to meet the critical demands, okay, or satisfy the critical interests of these different stakeholder groups, and to balance the trade-offs when they are opposed, and they are frequently in opposition to one another. So we have shareholders who want maximum returns, we have customers who want low prices, we have employees that want high wages. All of those things are going to end up competing in a very direct and real way in almost all firms. So let's think about who the stakeholders might be. External stakeholders, of course, customers. They want stability and they want product choice, plus they want low prices, right? So if you're, I'm someone who buys five boxes of tennis shoes, 5 pairs of tennis shoes at a time, because I have tennis shoes that I like, and I wear them out because I'm actually a walker. I'm a mall walker. I hate to admit that. Anyway, so I walk a lot, and I also do seminars, and I need these shoes. I want a stable product line. I want the choice to get the kinds of shoes that I need for the activities I engage in, but I also want low price, right? And the lower the better. So when they go on sale, that's when I buy them. That's going to tend to push down the revenues of the company, which of course would hurt shareholders, right? To lower revenues, lower profits, and also perhaps would hurt debt holders. Suppliers, on the other hand, including creditors, who are the suppliers of capital. So we have the suppliers who seek stability and higher prices. So the suppliers, whoever is supplying the leather in my tennis shoes, they want higher prices, all else equal. Well, you have customers that want low sale price, and that's going to be low revenue. You have suppliers who want a high product cost, so that's going to be higher expenses. You can see how that's going to start to squeeze if you're looking at it from the point of view of a shareholder. Unions, while they represent an internal stakeholder, that is employees, they're viewed as an external entity that wants basically higher wages and greater benefits for their members. That's also going to, all else equal, lead to higher expenses, lower profitability. And then you've got the government that's going to be in there with all 4 feet. So they're going to make rules and expect compliance to those rules. Probably tax revenues associated with it as well. If you live in the world I live in, it seems like government always wants more revenue. So they're going to have their own set of interests. Local communities and the public in general is going to provide infrastructure, both locally and nationally. And of course, we can see that if that's not done, it's going to disrupt company operations, and it's going to place additional burdens on the company. So there's going to have all of these external stakeholders are going to be driving the company in one direction or another, right? So all the stakeholders have demands, and they're all going to be competing with at least some other interests, right? So the internal stakeholders, they're going to be employees. They want stability. So we want to have a job next week, and they also want compensation growth. So they want a stable outcome, even though the world is a noisy place, right? Sales go up, sales go down. So the world's a noisy place. The employees want stability. They also want this compensation growth. Well, compensation growth, all else equal, is going to mean higher costs for the firm. So you can see how that might be competing against shareholders. So managers are going to be our employees, but they're a particular class of employees because they have this asymmetric information advantage, right? So when we talk about asymmetric information, what that means is the information flows between two different groups is not symmetric. It's not the same on both sides. And managers, they're the ones that, are negotiating contracts with big customers. They're the one dealing with the research scientists, looking at talking with the patent lawyers, all those types of things. So the managers know a lot about the prospects of the firm. So they have an information advantage over almost everybody else. And they can use that to pursue personal interests at the expense of the company. So board members would be another internal stakeholder. Their job, of course, is to monitor senior management. But are they really going to fulfill that role, or can they be derailed in that attempt? Well, we'll see some more on this as we go through this reading. So anyway, this idea that board members are supposed to be doing this monitoring, of course, they have their own interests. They want, they want stability. They also are compensated, those types of things. Well, how do we reconcile all these different interests? So the goals of the different stakeholders are often in conflict. Right? So this would be easy to see between, say, shareholders and employees. What? So shareholders want big profits. Employees want big wages. Well, those two things are going to compete with one another. So firms in the end are going to have to balance how we manage these trade-offs. And in a sense, we can think of this in broader terms as the need to balance current profitability with long-term profitability or profitability growth, right? So if you think of just balancing long-run profitability and profit growth, to the extent that you can optimize that, that's going to be the best way to satisfy as many of the desires of the various stakeholders as is possible, right? So the growth covers a lot of sins. To the extent that we're always making more money next year than we made last year, then we're going to be able to satisfy, have growing wages, higher profits, all those types of things are going to be easier to manage to the extent that we have these two things happening. But these two things, to some extent, will play off one another. Growth, of course, requires lots of investment and lots of risk. Firms may grow too fast, which means they're taking on projects that are not as profitable, which decline profitability for the firm. If they don't grow fast enough because they're conserving investment capital today, then they're going to be foregoing profitable projects. So to some extent, this idea of long-run profitability and profitability growth have to be balanced themselves. But if we can optimize that, we have the best chance of satisfying the most stakeholders, right? And of course, we have to maximize that or optimize that within the limits set by law. So there's also the opportunity to align stakeholder interests. So if we have these competing interests, well, maybe we can bring them so that they're going to look at the world very much the same. And there's lots of ways to do that, but a frequent way to do that is employee stock option programs. So you can think of equity or share-based compensation for the management team. Well, you've got the owners of the firm, that's the shareholders. You've got the managers of the firm. Well, are the managers maximizing the value of the firm, which is what the shareholders would like them to do? Well, one way to get them more inclined to make those value maximizing decisions is to say, look, I'm a shareholder. I've hired you as a manager. If I do well, you will do well. Why? Because you're going to have these employee stock options. So we're trying to mitigate some of these competing interests. In this case, the competing interest between shareholders and management or employees more generally would apply the same. And so what we're going to see is that we can sometimes align those interests or at least partially align them. Okay? Now, this brings us in, what we've really been talking about here is what's called the principal-agent relationship, also sometimes referred to as agency costs. Right? So we'll see that elsewhere in the curriculum, and they'll talk about agency costs. And the notion is this. Shareholders, in the simplest case, shareholders are principals. They own the firm. But, there's millions and millions of shares outstanding, and you, as a shareholder, own, 1/100 of the company, if it's Apple and you're talking about me. So I own 1/100 or less of the company. But then, so I'm a principal, and we have agents, right? Those are the management team that we have to run the company. Well, there's this problem that exists between us. When we hired the manager, what they said in the interview was, Mr. Shareholder or Mrs. Shareholder, I'm going to make decisions that will maximize the value of the firm so that you can so the share price will go up, so you're going to get the maximum returns possible. But then when they get into their role as managers, okay, they have this asymmetric information advantage on us, right? Which means that they can use that for their own, to pursue their own self-interests. So, and in the case of the modern corporation, shareholders often lack the information needed to confirm whether or not management is actually making value maximizing decisions. So do they really need a 4th corporate jet or a 10th corporate jet or whatever it is? So do they really have to fly first class to Paris again, right, or whatever it is going to be? So the ability to clearly identify the costs and the benefits of what management does, okay, well, those are all fuzzy equations, so we're not going to be able to identify that very precisely. And, you know, management can make it look like it's value-adding, perhaps, and therefore pursue their own interests. So how would that work? Well, of course, there's this idea of excessive perks. So do we really need another corporate retreat in Vail? So, or a bigger corporate retreat in Vail? Or is that just something that management likes to go out there because they like to ski? So they're going to do that at shareholder expense, but you know, that would be an excessive perk. Or, you know, how much time do they spend on the corporate jet? Okay. Top executives receive compensation increase or bonus, and this article is going to claim that it's irrespective of corporate performance. You could find studies that would dispute that, but nonetheless, the author of this article, I think, has a different view of the world than I do. I'll try to keep my own view under wraps. But nonetheless, so if they're receiving compensation increases, even when it's not related to performance, well, that's what we would call an entrenched management syndrome. So we got these managers, they're entrenched, they're powerful, they have lots of influence over the board. You know, for any one shareholder, it's not worth the battle of getting rid of them, so they just get more and more compensation over time. And it may be other things that are, in fact, more insidious, things like, you know, just expanding the size of the business. It's not that we're making value-adding acquisitions. We're just acquiring firms, and, you know, if it turns out to be positive NPV, that's great, but if it doesn't, that's no big deal either, because the bigger the firm, the higher the CEOs pay, right? So big firms pay their CEOs more than smaller firms. So if you're a CEO of a mid-sized company, and you're not worried about the ethical implications of it, my suggestion is you go out and just buy as many other firms as you can, make the company big through acquisition, and watch your salary go up. Well, that would be part of the principal agent problem. You're not really helping the shareholders, but you're still you are satisfying your own self-interest. So how do we mitigate these principal agent problems or mitigate agency costs? Well, we could develop governance procedures, okay, that motivate agents to behave in accordance with the goals set by the principals. So that would be something like the executive stock options. We could reduce asymmetric information problems. That could be either in the accounting or financial reporting world or in the real world. That is, some light is a great disinfectant, and to the extent that we can reduce asymmetry by you know, having external auditors come in, or, you know, outside evaluation, maybe encouraging institutional ownership, those types of things, that tends to reduce the information asymmetry, and therefore probably brings management more into line with the goals of the shareholders. And finally, of course, we can remove agents that misbehave or engage in unethical behavior, and unethical would be, you know, they're taking too many perks. Well, that's not ethical, right? There's some perquisite level that you can assume is value-adding as part of a compensation package, but if you're abusing that because you can, well, then that's going to be unethical, and you should, if the market for corporate control or the market for CEOs, if you want to think of it that way, were really efficient, well, we would get rid of those people and bring in new people that wouldn't do that sort of thing. Right? So unethical behavior, let's think about it in terms of business ethics. It's more than complying with the law. So I think we would all agree that ethics is a higher standard than the law. So what is it that makes for ethical behavior on the part of a business or a business management? Well, this unethical behavior could include self-dealing. So that's you know, agents that are using corporate funds or corporate assets to satisfy their personal desires. So again, we're back to the you know, the retreat in Vail. do we really need, you know, a 22,000 square foot retreat in Vail that is occupied, you know, 40 days a year or something? Information manipulation, okay, so if they're trying to hide bad behavior or to stack the deck in favor of big bonuses through manipulation of the financial statements, those types of things, that's going to be problematic. And then this article also lists anti-competitive behavior, so if they're trying to gain monopoly power, then that's going to have bad societal outcomes because, of course, competition is a wonderful thing. So they would list that as unethical behavior as well. I'm not sure I would agree, but nonetheless, I mean, I don't want to see anti-competitive outcomes, but I want my managers to try to be as dominant as possible. Is the way what I pay them for. But anyway, so anti-competitive behavior, like gaining, cornering the market, those types of things would be something that we would consider as well. So more unethical behaviors. This is opportunistic exploitation of suppliers and distributors in violation of contract terms. So, you know, you have a recession in an industry, and so suppliers are falling on hard times. The volume is down. They're trying to keep their fixed assets operating, all those types of things. And then because they're in a weakened position, whoever their customers are, so they're your suppliers, you're their customer, so you go to them and, you know, you cram some new terms down their throat because you can, well, that would be potentially unethical. So substandard working conditions. So for employees, so you can think of, well, there are societal standards for what the workplace looks like and feels, and safety requirements and those types of things. If you are working in an environment where people are starving, then they're willing to put up with you know, conditions that they might not put up with otherwise. And of course, you know, this idea of environmental degradation, we're not telling anyone about it, but we're dumping a bunch of 55-gallon drums of toxic muck into the river every night about 2 or 3 in the morning when no one else is looking. So we're making lots of profits. We don't have to pay for the proper disposal of this stuff. But the environment, everybody downstream, you know, they got 3-headed babies and that sort of thing. So, and then finally, corruption, generally bribery, those types of things are going to be unethical and, of course, in the United States, in fact, illegal. So it's going to be something that we would say is going to have negative societal externalities, right? So this is going to be limit the growth of the business environment, limit GDP growth, limit the people who have access to you know, the benefits of seeing a robust growth environment in their economy. What are the roots of unethical behavior? Well, of course, if you employ agents with flawed personalities, well, you hire unethical people. Don't be surprised when you get poor ethics behavior. So, but more subtly, if we didn't realize that a business situation had an ethical dimension. So if your sole aim was, I'm going to maximize profits at all costs, well, that's probably ignoring the ethical implications of the externalities associated with our decisions or our production process. That's probably not going to work very well either. Also, if you have an organizational culture that focuses only on economic outcomes, or you get pressure from management to meet unrealistic performance goals, well, you know, if you're doing everything you can as a manager and you feel like if you don't have 12% growth in bottom line this quarter, you're not going to have a job. Well, when people are stressed like that, and if that's, you know, not everybody can grow at 12% every quarter, right? So if you're having unrealistic performance expectations, then that's going to lead to people who might be subject to these problems anyway. They're going to be more tempted or more likely to engage in unethical behavior. So setting realistic goals in terms of the ethical environment, market constraints, those types of things would be one way to avoid this particular route of unethical behavior. So, you having fun? Yeah, this is a fairly high-level article where we're thinking about big concepts. So if you're struggling with this, I think there are some testable things. So hang with me here. We've got still a ways to go, but I think that this is something that I see testable material in. In fact, perhaps some at the margin, maybe some political pressure to test these sorts of things within the CFA program. So something I think you ought to pay attention to. So what are the actions in pursuit of ethical behavior? All right, so we have 4 slides on this. So there's a lot of things we can do to pursue ethical behavior. Okay, well, you know, on the last slide we said if you hire people with poor ethics to begin with, you're going to get bad outcomes. Well, we could hire and promote people with strong personal ethics, and that's going to lead to better outcomes, right? So same. Just the opposite side of the same coin. So maybe we want to make sure we get background checks, you know, review past employment history, talk to employers, those types of things. So second, we want to build an organization and culture that value highly ethical behavior. So I work at a university, and we had a president who wanted to instill a culture of compliance, meaning not, you know, like fall into line and think like I think, but compliance with federal regulation and, you know, all the funding strings and all that come with that, with federal monies. So, and that was a big portion of his presidency, and I think was largely successful. I don't think we had any major problems to begin with, but he was from the top saying, look, this is important. It's important because it's the right thing to do. It's also important to the sustainability of our organization. So, you know, going in and saying that this ethical behavior, it goes beyond just, you know, letter of the law. We want to be someone who has a reputation for being, well, zealous is not maybe the right word, but I'll use zealous in living up to covenants that we make or promises that we make and to donors and those types of things. So anyway, so explicitly state that ethical behavior is required. Employ leaders who are going to continually emphasize the necessity of high ethical standards, and then promote those who act ethically and sanction those who don't. Right? So build a culture of high ethical standards or high ethical behavior. That's number 2. Number 3, of course, would be to select leaders who are going to implement number 2. That is, we've got to have a culture that's going to promote this. 4, we need to establish a decision process that incorporates a sense of ethics, a moral compass, rights theory, which we're going to talk about in a little while, the theory of justice we'll talk about, but incorporates these ideas into the way we make decisions. And the point here that the authors are trying to make is that when we come to a decision, in particular those key decisions that we know are going to have significant ethical overtones, then we need to ask ourselves some yes or no questions. Things like, does this decision meet our code of ethics and standards? So if we decide to zig instead of zag, okay, is that going to be something that we think is in compliance with our culture of ethics? Okay, we can also ask the question, how's it going to look if this decision is widely reported to stakeholders in the press? So if you think of, you know, patience is what parents possess when people are watching, right? So well, when people are watching, we do one thing. When they're not watching, we do something else. Well, if we think we're making this decision in private, okay, but if it turned out that this were going to be vetted and, you know, we were going to be exposed through the press to the many stakeholders of the company, okay, then what's going to be how are we going to feel about it then? Will we view it the same way we're viewing it today? And the other way to think of this was, hey, there's people out there whose opinion I value, and how would they view this decision? Would they be pleased that I made the decision to zig rather than zag, or should it be the other way around? Right? So we want to establish this decision process that incorporates the notion of a moral compass and where we think about the importance of business ethics. So we want to have an ethics officer who's going to articulate what our ethics are, that's going to propose changes in our code of ethics maybe, that's going to train and monitor and revise the code, and it's going to make sure that it's adhered to. And then we want to show, as leaders, moral courage by supporting managers who make tough decisions consistent with good business ethics, even if it comes at the expense of short-term profits. So we can't, and I think there's lots of businesses that are ruined in the pursuit of short-term profits. You've got to be working hard every day, right? Certainly that's the law of the jungle. But if we let the pursuit of short-term profits or short-term profit growth outweigh what we think are good decisions that balance the needs of the many stakeholders, even if that means, in my view, shareholders would be a preeminent group, right, or a predominant group, but we still have these other needs that need to be balanced. If you let those short-term profits overwhelm your decision making, well, then you're going to end up hurting the company in the long run. And finally, we want to establish strong corporate governance procedures. And this material is treated at a couple of places across the curriculum. But this is sort of a best practices, really abbreviated list of best practices for corporate management and setting the very top, the attitude about ethics or ethical behavior from the very top. So we want a majority of the board of directors that are independent. That is, they're knowledgeable about the industry and about business, but they don't have any ties to the company other than, they're board service. So they're not consultants, they're not, presidents of key customers or anything like that. We want a chairman and a CEO, and we don't want them to be the same person, right? So they both have influence over the agenda that's set by the board, those types of things. And we want the chairman to be an independent outside director. So the compensation committee, so these are the people that are going to determine the compensation of key management positions. Well, we want that made up exclusively of these outside directors, and then the board should also retain outside auditors, okay, that don't have any conflict of interest. So that is, they should be on the audit committee, and they should hire the accounting audits and all that sort of stuff. So they should retain auditors and outside evaluators who they know can be independent, or at least have the greatest chance to be independent, right? Okay, so business ethics here. Treating stakeholders fairly and ethically is ultimately going to benefit the firm and its managers, right? So the firm does well, the managers do well, then stakeholders are going to do well over time. So if we accept this premise that treating stakeholders fairly and ethically is going to ultimately benefit the firm and society overall, which I don't think is an outlandish proposition. I think, in fact, it is something that is correct. We certainly see cases on the other side of that when managers are not ethical. We see disastrous impact or disastrous outcomes in some cases. So we have this notion that we want to have this ethical behavior. We still have to decide, well, how far do you go to satisfy entities other than, or stakeholders other than, those people who actually own the business. So this idea of noblesse oblige, noblesse as in noble, oblige, right, meaning obligation, so a more noble obligation, argues that those who benefit most from society, which would include successful business owners or stakeholders, those types, have a moral obligation to do the right thing and to act in the best interest of society. So as you climb up the ladder of success, society's done more and more for you. So you take equal endowments. There's maybe some luck in how high you climb, right? Well, if you end up way up here, then maybe you have a greater obligation to make decisions that are going to benefit society than somebody else who has worked equally hard and didn't have the same breaks or something along those lines, right? So this an obligation to be more noble comes with this rising success is the idea. Now, one of the, I think, really testable implications from this reading is the idea of comparing and contrasting these different philosophies of business ethics. So we have 5 of them here that you probably want to be able to bounce one off of the other. And I see this as a great opportunity to have a comment question, right? So that's where they go through and they say, well, one person makes a comment A and somebody else makes a comment B, and then you have to determine, well, is A is it congruent with the Friedman Doctrine or utilitarianism, and B, is it rights theory or justice theories, those types of things. So I don't think you have to become a business esthetician, right? Somebody who, that's a hard word to say, and it sounds like you're cutting hair when you say it even correctly. But if you're going to become an expert on business ethics, getting around how to pronounce that again, if you become an expert on business ethics, then that's a great undertaking, right? But do that the second week in June. So all you need to know now is the basics of what's going on with each of these, and we're going to talk about them. We have a slide on each of them. But basically, the Friedman Doctrine would say, look, there's rules to the game. You optimize under the rules. Utilitarianism would say, let's maximize societal well-being. The Kantian Ethics would say, well, you can talk all you want about maximizing societal well-being, but people are not just inputs, right? They're moral beings, and you have to treat them differently than you would propane, right? Rights theory talks about the fundamental importance of rights, okay, versus things like societal well-being. And then justice theories, this one is, you got to be a little more careful with this one, but it has some overtones, in particular the veil of ignorance idea that I think would be something that would be easy to plug into a question. So for each of these 5 things, you need to know a little bit about what they're describing and the differences, maybe shortcomings of each of them, because none of them are complete as a standalone, this is how we view ethics in this world. So Milton Friedman, of course, one of the great economists of our time, said that, or proposed that the only social responsibility is to maximize profits. Okay, so that is shareholder wealth. But you have to do so within the rules of the game, so you got to comply with environmental regulation, you know, whatever else is going on with the government, those types of things. And through open and fair competition, so you're not defrauding the markets, or you're not deceiving shareholders or anything like that. So you're not perpetrating fraud, you're not intentionally deceiving, okay, you're obeying laws and regulations. Under that environment, you maximize your profits, right? So that would be a very laissez-faire approach to business ethics. And you have to remember that in many cases the rules are incomplete or poorly defined. So does that provide, you know, sort of gaps in the law that businesses can exploit? And the answer is probably yes. So maybe as a complete doctrine, the Friedman Doctrine is not correct. What about utilitarianism? So here, utilitarianism essentially asserts that the morality of actions is determined by their consequences. So you have good consequences, that was a moral decision. You have bad consequences, that was I don't even say immoral decision, but you know, a decision that wasn't as good. And this is where we get the idea of cost-benefit analysis. So what are the costs of what we're doing? What are the benefits of doing this? And if the benefits are greater than the costs, you do it. If the costs are greater than the benefits, then you don't. The trouble with this is, well, I guess the point here is, if you think of this in terms of ethics, what you're trying to do is you're seeking the greatest good for the greatest number of people. Right? So we're going to say, look, if we do this, it's going to have, you know, big benefits for this particular and particularly wide swath of society. Okay, well, that would be maximizing overall societal utility. Utility is just a fancy word for happiness, right? So maximizing societal utility, and if we can do that, make decisions that maximize utility for the greatest number of people, that would be our obligation. The trouble with that, of course, is costs and benefits aren't easily observable, so we know what explicit costs are and, you know, tangible benefits. But there's, you know, social benefits, there's social costs and, you know, externalities that occur and all these things that are just going to be really hard to bring into the equation. And it can also lead to this, which I would say is probably its greatest downfall. So that is the notion that, you're going to benefit this really wide segment of society, okay, but you're going to do so on the backs of a very small sliver of society, right? So that would be like slavery. So if we wanted to enslave people that, you know, had small ear canals, right? Well, we'd measure ear canals and we'd find, okay, the bottom 10% of society in the size of the ear canal, they're going to be slaves, and so we're not going to pay them. We're going to work them 14 hours a day. And we're going to, well, it sounds like a little like working for Kaplan now that I think about it. But anyway, they're going to, you know, we're going to usurp the benefits that they would create and distribute them widely. So we're going to have this great infrastructure project that's going to mean really good things for lots of people, that sort of stuff. So anyway, but clearly, if you are maximizing social utility across a society, but you are exploiting a small group to do it, well, that doesn't seem like a very ethical decision. Kantian Ethics says, look, you can talk all you want about rules and utility and all that sort of stuff, but people are moral beings, okay, and they deserve to be treated with dignity and respect. So it doesn't matter what else you do. If you have this really disgusting sweatshop labor environment, then that's going to be unethical and doesn't matter what else happens, right? So it's incomplete because it doesn't bring in our ability to address, you know, sympathy and caring, and it also doesn't consider ex-ante endowments, those types of things. But nonetheless, the notion that people are not propane, people are not salt, people are not sheet metal. They are different than other inputs into the societal production function. Well, that's the Kantian view. Okay, rights theory. Rights theory is an interesting view and one that I think certainly has merit in our view of the world. But the notion is that fundamental rights trump the collective good, right? So I have a right I have a right to breathe, let's say that. So if for some reason it would be better for society if I weren't breathing, which, you know, college professors really are just sort of a leech on society to begin with, so that might be true in my case, okay, but nonetheless, if I would stop breathing, society would be better off. Well, that's not sufficient to terminate my life or terminate my ability to breathe, because I have a fundamental right to be able to breathe, right? So shareholders, employees, they have these fundamental rights, and those rights have to be protected. So business managers have to have this moral compass, and they have to respect these rights. So businesses also have rights, right? So a corporation is simply a collection of individuals. They're owned by people at the end of the day. A collection of individuals that are doing business and trying to advance their economic self-interest. Okay, but the rights that go with the business, well, they impose the obligation to respect the rights of others. So rights theory says, look, doesn't matter what's good for, well, it doesn't matter. That's too strong. But if you have things that would be good for the collective, okay, well, there's still fundamental rights that have to be honored, and that's rights theory. Finally here, the justice theories, okay, and this is where we're seeking a fair and equitable distribution of goods and services. So this is John Rawls, and he would argue that rules are fair if we would all agree they are fair when deciding under a veil of ignorance. And I think that's probably worth remembering, this idea of a veil of ignorance. So a veil of ignorance is the idea that we would all get together and agree on the rules of the game without knowing what the outcomes are going to be ex ante, right? So and the way it's applied is we don't even know our particular state in the world to begin with. So if you took us back to a primal state where all of us had the same endowment, it's going to evolve so that some are richer than others. Well, if we would all agree on the rules as being fair to begin with, then that would be, the veil of ignorance would be a way to make for fair rules, because we'd all have to agree that the rules of the game were fair before we knew what the outcomes were. So it's sort of the opposite of what government does. So government sees the outcomes and then makes the rules, right? So anyway, if we could do that, if we could apply the veil of ignorance, or we could think through a problem as if we were under a veil of ignorance, well, that might be a way to come up with good ethical decisions. So this is getting closer to the edge of what I personally can tolerate, but nonetheless, so we're supposed to maximize basic liberty compatible with the same liberty for others. So beyond basic liberty, inequality of results are only consistent with the differencing principle. And the differencing principle, okay, says that unequal distributions are only justified if they benefit the least advantaged members of society. So we can have a production process, we can have outcomes or allocation of the benefits from that be different, okay, but they're only going to be justified if we give bigger shares to the least advantaged members of society. So effectively, we're going to be equalizing outcomes overall. Okay, so as they spend some time talking about Nike and justice theories, this is, if you're the typical CFA candidate, then way before your time, so we're talking almost 20 years ago, 18, 19 years ago, Nike took a lot of heat over working conditions in the plants that made their shoes in Asia. In particular, there was one in Vietnam that some observers went there and they thought the working conditions were just deplorable. Nike didn't own the plant, so Nike doesn't make tennis shoes, right? Nike's just a marketing company. They don't know if they've ever made a tennis shoe. They pass all that off to production partners. Well, the production partners were running this plant, and according to the people that looked at it, they said this was abysmal, and Nike was benefiting from it, and there was a big political flare-up, all that sort of stuff. So the supplier's treatment of workers might be argued to pass the differencing principle, okay, because the notion was, well, yeah, it's not where I want my kids to be working, so I actually went to the Nike plant in real time, so I was there the year it happened. Shows you how old I am. I was 12. Right, 18 years ago. Anyway, and the point was, well, even though it looked deplorable to us, okay, the people that were working there thought it was a great job because their opportunity cost was so low. So while it's difficult for us to imagine that this veil of ignorance would work, It might, in fact, if you think of it as, what is the level of outcome or level of endowment prior to this decision being made. So anyway, but the point here is to use this veil of ignorance to help us to define or hone our moral compass. And as a wrap-up here, what's going to be important to this reading? Okay, well, the idea of stakeholder impact analysis, that was the SIA. Okay, what is that? Where does it come from? There's no technical part to it, so it's not like we're talking about leverage impact analysis in stock purchases, right? So we're trying to think through what are the needs and desires of the shareholders, how do we satisfy those types of things. I think this idea of principal-agent relationships, or agency costs as it's called elsewhere in the curriculum, is something that you want to have a handle on. The roots of unethical behavior, well, if you hire unethical people, you're going to get bad behavior. But then finally, this idea of the philosophies. Okay, these two things, I think, would be where I would spend my time, just because the philosophies would be a great compare, contrast type questions, and the principal-agent relationship comes up several times elsewhere in the curriculum, so might be able to learn something about it from this particular reading that you can use elsewhere. So that is our initial treatment of business ethics, and something that I think is well worth studying.